time, so I'll have to start home. So residential care, so new rules from the 1st of November. And so I guess, what is residential care? We touched on earlier. It's really at that point where fully supported living is really the only alternative. It's where that home care is no longer enough. And look, for some people, I've seen it myself personally. Some people have actually moved into care and have actually picked up. They might be living at home, but somewhat lonely. Make the move in the residential care. They can get involved in some more activities, and that can be good for their well-being. So it's not all bad news. But I guess importantly, there's a lot of decisions here to be made, and so starting with the logical ones, as to where it would be, where to live. And obviously there's a lot of considerations, things to think about, the location, obviously affordability, the proximity to your friends and family is going to be a key one, but also to your service providers, like your doctors and your healthcare providers. The quality of care and the services offered in each home, I guess that's something that's somewhat harder to really determine, but very important nonetheless. The reputation and reviews are also important because, and that's not always easy to determine. A good place to start is to jump on the My Aged Care website, myagedcare.gov.au, and you can do what they call a service finder, which you can actually put a couple of different homes side by side, do a comparison. Obviously price is one thing, but it's also size of the rooms, whether you're sharing an ensuite, got your own ensuite. Each home now has to have there's a star rating system now, so similar to like a Google review, you can have a 1 star being the worst right through to a 5 star being the best. And so that's done across a range of different metrics, so that can be a useful way to compare one home over the other. Ultimately, though, I think you can't beat that actual visit, the personal visit. Take the person in, see if they're comfortable, and we might have some friends and family that have had recommendations in other areas. So I think that's still very probably the best way to ultimately determine it. There are in some places I haven't heard it specifically, but I'm aware that in Toowoomba there are a placement service. 1 or 2 placement services available. So if for some reason you haven't got the time or the headspace to do that legwork yourself, then there are providers that can for a fee they can actually help you with some of that. It'd be a matter of sitting down with them and saying, look, this is what we want, and they go away and hopefully find what you need. So let's crack into the financial side of things. So what our costs are, we can't escape that. So we'll start and we'll work from left to right. So the accommodation on the left-hand side. So the rates are, once again, they should all be published on their own websites, but again through the myagedcare.gov.au. And so this allows people to check out the fees, do some comparisons. For people with very low financial means, there are some financial concessions available, and so you may not necessarily have to pay that full amount. But again, that gets pretty complicated, so we won't focus too much on that. But just to be aware that it's not everyone would have to pay that full price. One of the choices that you'll have with accommodation is that you can choose. And so that there'll be an upfront, what they call a refundable accommodation deposit, which is abbreviated as a RAD. You'll hear that terminology, RAD, RAD, thrown around. Or the alternative is if you don't have the financial means or for whatever reason, you can choose to pay a daily fee. They call it a daily accommodation payment or a DAP. In some circumstances, some people will actually end up doing a combination of the two. They might have some money available, they can put that towards the RAD, the lump sum, and then they'll keep some money back to pay for the daily accommodation payment. The second and the third fee, so the everyday living costs and the hotel contributions. So firstly, the everyday living, or the basic daily care fee, which is the top one. So the daily contribution is currently $65.55 per day. And so regardless of your financial status, whether you're a full pensioner, part pensioner, self-funded, everyone pays that same fee. And that's essentially just put towards the cost of general sort of living costs within the home. Now that fee is actually set at 85% of the maximum single age pension rate. And so as the age pension rate goes up every 6 months, then that basic daily fee will also index the same way. But I guess the theory is that for someone on their own that was just had limited assets, was just full age pension, then the most that they could take or the home could charge is 85%, which would then leave them with the other 15% to spend on their own personal expenses. Because the 85% is actually excluding the supplements that you get with age pension, so you end up with a bit more than 15% of the total amount left over. This new one, this hotel contribution, so this is a whole new fee, or a different name for probably a fee that was there previously. And so this one can range anywhere from $0 to $22.15 per day currently. Once again, it's indexed, so that will go up. And again, based on your financial means, so the at the worst case scenario, you'll pay the full $22.15 per day if you're self-funding, or an full age pensioner won't pay anything towards that one, and a lot of people will be somewhere in between. So I guess in round terms, everyone will pay just under that $24,000 per annum in the basic daily fee. It's roughly $2,000 a month that everyone will pay. Whether you pay an additional hotelling contribution, up to about another 8,000 a year, so you're up around the 32,000 a year in those fees. The next, and probably the big one, is what they call the non-clinical care contribution fee, another fancy name for a means tested fee. They like to come up with new names, so here's another one. And so this one will vary, and in the worst case, you'll pay up to $36,923 per annum, which is equivalent to $101.16 per day. Whereas, depending on your means, you may not have to pay anything towards that, or a lot of people will pay somewhere in between those two amounts. So I guess, and again, just looking at the total numbers, in the worst case scenario, if you have to pay the full, well, everyone pays the basic daily fee, so just under $24,000. If you're paying the full $8,000 a year hotelling contribution, then you're paying another $36,923 non-clinical care. You're up around that $69,000 in per annum cost. Interestingly, with the non-clinical care contribution, it is subject to a lifetime cap. Again, it is indexed. It's currently, oops, didn't mean to do that. So it's currently at $135,318. It's indexed as well. And so that lifetime cap means that it's a maximum of 4 years. So I guess that's the good news, is that you won't pay that amount forever. At the very worst, you'll pay it for 4 years. Or if you hit your lifetime cap, you'll stop paying at that point. The other thing that just on that lifetime cap is that it's important to keep track of your supported home means tested fees, because if you've paid supported home means tested fees, let's say over a couple of years, and it's $20,000, that $20,000 will count towards the lifetime cap. And so, using that example, so you've already used $20,000 of supported home fees, so your lifetime cap is $135,000 less 20, so it's $115. So, which means that you'll reach that in care at a quicker point. But it's a lot to process, isn't it? A lot and obviously a lot of different variables that come out of that. Just to break down that accommodation payment, that left-hand side one that we had initially. So as I touched on, there'll be a choice of a lump sum, a RAD, a daily payment, which is a DAP or a combination of the two. The daily payment or the DAP is effectively like paying rent or almost like paying interest on an outstanding loan. And by default, so that the day someone enters permanent care, the default is they'll start that daily accommodation fee. If someone then can afford or has money available to pay the lump sum, then the ongoing fees are adjusted from when that lump sum payment is received. But everyone starts out on the daily fee until the payment is made. And you've also got, officially you've got 6 months to decide. You might have someone go in there and they're unsure of in the process of rearranging their finances, and so you don't have to make a choice within the first 6 months. But just remembering that, the daily fee starts from day one. Now that there's an interest rate which is it changes every quarter. The current interest rate that's applicable to that is 7.61%. So it's quite high. Last year it actually got closer to 9%, whereas a few years ago it was only 4 or 5%. So it does vary, but it is an important consideration. And so if you've got just money in the bank that's earning 3 or 4% and you're paying interest at 7.61%, then you've got to question whether you should be doing it the right way. Now, the other thing that's come into play, and so people that are already in the system, they're fully, if they pay a lump sum, their refundable accommodation deposit is fully refundable. Whereas from the 1st of November, any new people entering into care for the first time, the home will actually now start deducting what they call a 2% retention fee. And so it's 2% per annum. They'll actually deduct it on a monthly basis, so it's not. It works out a little bit different to just 2% of what you put in, but and that's going to make paperwork for the homes crazy complicated. So I'm not sure how they'll get on with that, but that's another issue. But and look, once you make a decision, whether you pay a lump sum or a daily fee or a combination, effectively you can chop and change. You're not, once you've made that decision, you're not fixed on that. You might say, look, I'll start with a daily fee. I've got some money maturing down the track. I'll put some of that towards, for example. But you're in control of how much you choose. But again, I think it's because of the flow and impacts of these decisions, it's important that you get some form of advice because I think it's something that would be difficult to do on your own. So just a little bit of a deeper dive into what RADs, the refundable accommodation deposits, really are. And so effectively they're buying the right to live there. So and so they'll fluctuate. Here in Toowoomba, I've seen RADs vary from probably 400,000 to the high 900,000s. I've seen RADs as low as 300,000. I've seen one as high as 2.97 million, which was in Sydney. You get a nice view of the coat hanger, but probably arguably whether you get any better care, I'm not sure. But it gives you an idea, and obviously the way how they're setting their prices are somewhat based on the property or where the home is. So that the worst case scenario, as I said, that 2% per annum retention amount is deducted. There's a 5-year cap on that. So the worst case scenario, 5 years of 2%. So 10% is the worst. Is the most that can be retained from that lump sum, the RAD. And then but the balance comes back to your estate effectively when the resident leaves. In some cases, for cash flow reasons, people might say, well, I can afford to put some money as a lump sum, but then I can't afford to pay all of it, but I can have some of my daily fees, for example, offset against that lump sum. So that can be done, but just remembering that you're effectively still paying that interest, that 7.61% interest on the amount that you're owing. So if you're if you're having some of your daily fees that are offset against the RAD, then you're going to reduce what's coming back to you at the end. One of the, I guess, aside from the interest rate, kind of financial considerations, the fact that the government guaranteed, is a nice thing. You've got that protection. Your money is held effectively in trust. One advantage for people that may be on the edge, possibly for age pension purposes, is that they can actually, the lump sum payment is actually exempt from the age pension asset test. So that can actually enhance people's age pension entitlement. And so, again, you've got to sort of run the numbers with that, but that can be quite a powerful way. Someone might be just outside age pension eligibility, and by paying a lump sum, that might put them in to at least get a part pension. And so, that, again, that's just a scenario, but that can be a way to help cover some of the ongoing costs. Let's look at a case study where we'll try and, I suppose, bring or highlight some of the many considerations that are taken into account. And admittedly, this scenario is probably one of the lesser complicated ones. You can obviously get a lot more complex depending on people's financial situations. But so we'll start with Madge. So Madge is a widow who's moving into residential care. She agrees to pay accommodation payment of $500,000. So her only assets include her own home, which is valued at $850,000, and some cash of $50,000. So her total assets are $900,000. So one of the questions, particularly in her case, because the house is such a big part of her overall assets, is one of the obvious questions is, does the home count? So how the home is assessed for aged care can differ to how it's assessed for the age pension. So there are some exceptions here, and there's I won't get into it today, but there's a definition or a terminology called a protected person. And so so for example, Madge had a carer that was living in the home for more than 2 years, then if that carer was to remain in the home, then that changes the rules. But in this case, we can assume that she was on her own, and so for aged care purposes, her home, for as long as she continues to hold that home, then it's actually assessed, but only at $210,000, which is an indexed amount. So that's quite a concession. When a house is valued at $850,000. If she happened to decide to rent her home, after she moved into care, then the rental income, or the net rental income, so after expenses, would be counted as assessable income both for the settling age pension purposes, or DVA, as well as the aged care fees. So, but once again, the value of the home is actually only capped at the $210,000. For aged pension purposes, a 2-year exemption would also apply before the home is assessed at full market value. So, from Madge's point of view, for the first 2 years, there'd be no impact. She should still be continuing to receive full age pension, but after 2 years, then the value of the home would actually, if she chose to just to leave it, or whether it was rented or just left vacant, then that value all of a sudden would come into play. And so that would materially change both her age pension entitlements, but then potentially her aged care fees as well. So hopefully you can start to sort of, I suppose, play out some of the many considerations that you've got to play with. And as I said, this is probably a somewhat easier example than some that we come across. But so some of the things that she would be considering, and hopefully she's got the family support around her to help her with it. But one would be, does she release the equity? In other words, does she sell the home to help pay for the ongoing costs? The second one could be, does she rent out the home to give her some cash flow, but then obviously, which would go towards paying the daily fee, but then obviously she wouldn't have the lump sum to pay the RAD. A third, probably less common example would be the borrowing against the home, whether that's be via some form of reverse mortgage, where you can actually borrow against the value of the home, or alternatively, if she been an age pensioner, which she would have been, she has got some mechanism where she could borrow some of her age pension or future age pension entitlement. She can borrow up to 150% of the maximum age pension she has. So that can be a way to sort of help some short-term cash flow. But on the investment side of things, there's a range of different things. It's an area that we have quite a bit to do with. There can be some quite effective ways to manage the investments. There's special types of special purpose types of investments, such as annuities, that can play an important role to actually improve both her cash flow, but also reduce her age pension, in some cases. So there's a range of different things that can be used. We've actually used annuities also for people that are self-funded. They've got rather than have money in the bank, you can actually get often better rates of return, but then get some age pension and age care concessions. So there's a whole heap of different things there. We haven't got time to go through everything today, but I guess it's just to help outline some of the decisions that should be faced with. So probably unsurprisingly, advice is the key. But as I say, she'll need a lot of help to consider all these different issues. And it's not only the financial issues; it's the other. It's the home. She might have some other family members wanting to live in the home. It might be a case of that they don't want to deal with having to rent the home out. There can be a whole heap of different scenarios, and so that's where really it's important to get the family group together and have that conversation, which is not always an easy one to have, but I think it's super important because the risks of sort of doing it wrong can be long and wide-reaching. So I guess getting to the end now, if it all seems a bit overwhelming, which the feedback we generally get is that yes, it is. We certainly understand. The good news is that we can assist you navigate through this. Now, how we can help will depend on what life stage you're at and where you're at in the journey. We do strongly encourage you to start the conversations with your families. Because, as we said earlier, because it's such a long process, whether it's home care from start to finish, whether it's residential care, because we all know the amount of times that residential care is forced upon people, and then they have to make quick decisions, and it's often when you might have a plan A, so if something happens, I want to go into this home. When the time comes, there's no guarantee that home's going to have a room available that's suitable. And so, you really then got to have that plan B in place. So, we actually decided whether we'd hold the seminars this month, given that the rules have only just freshly come in, or whether we wait to say January. In the end, I said no. I think it's important to do it now because for a lot of families, as coming into Christmas, there'll be a lot of families will come together. And so it's probably a really important time to have those conversations in amongst the Christmas pudding and everything else. And look, they're not easy conversations to have, but very important to actually hopefully help out a little bit. One of the flyers in the packs there we've included was just a few pointers or tips on how to have those difficult conversations. Probably more directed at the younger members of the family. But just ways to I suppose look out some of the key sort of things to find. I often hear people say that might be a long way from mum and dad. Don't get to see them in person that often, but they say, I want to talk to them on the phone. That they sound good, but then when I see them in person, there can be a different scenario. So so I think just a really good time to do it now. So where to for help? There's actually some really good free resources that you can access and a good place to start. So the My Aged Care website, .gov.au. Oops, oh geez. We'll probably have to have a Teams meeting or something, probably easier than a seminar, isn't it, to catch people. Okay, so yeah, so the free resources, and I'll put this down. So the My Aged Care website, there's a 1-800 number, 1-800-227-475. And as I touched on earlier, there's some of the FIS offices in the bigger regions, such as here, the aged care specialist offices, if you can get an appointment with them. Obviously, they can't give personal advice, they can give some general information and perhaps outline some different scenarios. In terms of how we can help at Carrick Aland Wealth Planning, so we've actually we've got a range of different service offerings. As everyone's situation is different, our costs will vary and depend on a range of different factors, and what type of care that you're seeking, what level of involvement that you'd like us to have, and also the complexity of the advice. So our two main offerings is what we call, the first one is our starter service, so that comes in under the general advice information category. And so that's where we provide general advice, guidance on both the supported home areas and also the residential aged care systems. And so that will involve a full appointment, it's normally around an hour and a half, where we cover a lot of information. We'll actually get Joel here at the back, we'll actually have a quick phone call or catch up prior to that meeting, just to gather some details. So when we have the meeting together, we're able to make something meaningful. And so the starter package, we stop short of giving personal advice because we don't consider all the different scenarios. But what we can do is give you some guidance, give you some examples of the sort of advice or some of the strategies that we might look at. Some of the tips and tricks along the way. And so that for that starter service pack, so that's typically $990 including GST. And so as I say, that's often designed for people not sure where to start, but just want a starting point. If people are after that, if they're happy to go on without, they don't need us to be involved, then that's fine. For people that want that more personal, individualised advice, then we can tailor our personal advice. Normally from that initial meeting, we can then from there we can provide a quote, because we'll have a pretty good idea of the areas that we can help you with. And so that personalised financial advice will range typically from around about 5,500, including GST, up to about 11,000 for the complex situations. Again, the exact amount will vary somewhat on what work's involved, and also whether there's investment recommendations incorporated in that. But again, we can give you a good idea once that meeting's held. I guess for us, and certainly based on the experience that we've had with helping other clients, is that the feedback we've had is that we've been able to demonstrate strong value above and beyond those costs. For us as financial planners, we have to be able to show that any advice we provide is putting you in a better position, or otherwise there's no point doing it. So and we've got professional standards that we have to adhere to. So we're very clear on that. And so hopefully that that we can show you that we can put you in a much stronger position. But also, I guess again, the feedback from other clients who have used our services is that just having that sort of that stress removed of just feeling more comfortable about knowing where they are, and they've got the financial side of it organised, so so they can focus on other areas which at the time there's plenty of other things to be thinking about, not having to worry about the financials. So to more information, book an appointment, please contact our friendly team. So I mentioned Joel up the back would be the guy that would make the initial contact with you, just a quick chat, just to get a few details, and then from there we'll meet with myself. So we've got to the end now. I did want to, happy to take any questions on the residential care side of things. Yes.
What's the advantage, no, I'll put it another way. If you have your initial assessment and you're only in level 1 and you have to, for some reason or other, move up level 4 or 5 further, does that initial assessment help you as opposed to if you hadn't had the assessment at all?
Yeah, I believe so, because really once you've got level 1, at least you're in the system, and it is normally quicker to upgrade than the big waiting time is in that initial system. The other thing that a lot of people get confused with is that base level and Commonwealth Home Support Program, which is also done through My Aged Care, but it starts and stops there. So you can't jump from the Commonwealth Home Support, not currently anyway. There's actually thoughts about it. I think in 2027 they might roll all the Commonwealth Home Support Program people into the new system, but at the moment, so that's a mistake that people often make, is they've said, I've dealt with My Aged Care, I've got the Commonwealth Home Support Program, but that one starts and stops there. So unlike the level 1, where you're in the formal system. Yeah, so I just wanted to make that point, because that's something that comes up a lot. And it is confusing because it all starts from My Aged Care, so people feel that it's the same thing. Yes.
Does My Aged Care make any attempt to do recurring assessments? Because obviously everyone's going to deteriorate.
Yes.
Or is that entirely the responsibility of the people at home to ring and say, I've got my care, they can do, but really I feel I'm at fault?
Yeah.
I mean, do you get any assessment?
No, I don't think, and as you can imagine, like certainly they're under the pump as it is, so it's really up to the people. I mean, if you're working with a good home care provider, then they should be proactive in reassessing. And there's also there's a material, there's a financial incentive for the home care provider to move you up the package, because the 10% fee is going to be bigger, and I know some providers that really only get interested in people once they're in the higher 3 or 4. The level 1s or 2s, they sort of say, well, it's not enough in it for them to get too excited about, so we'll tend not to get a great deal looked after. Whereas, I shouldn't cast that aspersion across all providers, because I'm sure that's not the case in all cases. But I think it's just I think once you understand the way the providers are getting remunerated, it probably helps explaining things a bit more. That makes sense. Yes.
I'm not sure if I've worked it out right. If you're self-funded retiree and you go into this accommodation, residential care, right, you're up for what, 700,000 or whatever to get in. Yep. And then, if I worked it out right, that it's about 68,000 a year.
That's right, yes.
Okay, what happens when you run out of money? Because particularly if only one is in and you can't therefore sell your home, and you're going to blow through a fair whack of money very fast.
Yeah, no, that certainly can be the case, and it's a really good question. One of the things that will probably help touched on is that lifetime cap. It's that 68,000 that you said, that's kind of the worst case scenario. If you're paying the maximum means tested fee, the non-clinical care contribution. That one, you won't pay that forever after. That lifetime cap will kick in after some time, so that provides some relief.
For 4 years you've still gone through 300,000.
Yes. Yeah, look, that's right. It's actually interestingly, we actually use a company called Aged Care Steps, which provide us a lot of the technical background support, because it's such a big area, we couldn't sort of do it all ourselves. I've seen figures quoted by, and they've got them obviously from some government departments, but the suggestion is that the cost of one person in an aged care home room, the full cost of that to the government is upwards of $170,000 per annum. And so I suppose the government's argument is that the worst case, people that can afford to pay the 69,000, but it's still only still a small percentage relatively, of the total cost of care. That's for some people with limited assets, they might only be paying $24,000 a year. It's far from a perfect system, and I guess as we know, Australia's faced with a massive wave of baby boomers entering into care, and so these changes that were made. I remember seeing the dog because we did a seminar back in March because we were expecting things to start on 1 July. I think, and from memory, I think it was something like, the residential care, that the government were tipping in about 74% of the total cost under the old system, and so this new system was expected to move the dial to about 72%. So it was only going to, for them, it was picking up about an extra 2% of the cost, but no doubt, no doubt the people that have got assets will, are paying the lion's share of that, and the fully supported pensioners are only doing a much smaller amount. So, and this can lead to a number of other things as well. I guess in the theme of sort of forward, future planning, we work with clients, where sometimes where it's appropriate, some giving away of assets, ahead of time can actually ease the aged care costs at some future point. Having said that, the dial's also shifted there because under the new system now, you'll pay the maximum fees at a much lower level than under the old system. And so, to your point, I think under the old system, I think as a couple you had to have in excess of about $3.5 million before you hit the maximum fees. Whereas now that's I think it's reduced to a bit over $2 million as a couple. So it's going to more people are going to pay more. That sort of cast the net wider. So that's cool. It's pretty scary. And it was interesting when the government did their reviews, when this sort of aged care reform was being considered, one of the options they were looking at was to introduce some form of like a Medicare levy, to try and sort of get more money into the system to be able to spread the cost. But I guess the counter argument to that is that the young people that say, we're then funding the funding. It's a hard system, isn't it?
Hear you right that those that are in aged care now, like the residential care, that's not going to change.
That's right. So there's a few variations to that. If they moved out of one home and into another, then even that depends. If they moved into a higher. So say their bond was $700,000 and they moved out of that one and went into somewhere that was $800,000, then there might be an adjustment type thing there. And sometimes some of the new rules can come into play in that sort of scenario. But there's broadly what they call the no worse off principle for people that were either in home care or had packages before the 12th of September 24, or were in residential care before 1st of November. No more questions? Might break then for the volunteer. Sorry, and before we do that, if I could encourage you just to take a few moments just to give us some feedback. We've got the feedback form. Please give us some feedback.